How's it going, everyone? My name is Amos, and I'm just looking for somebody, anybody. Can someone please talk me out of buying into Clorox stock? Or maybe I can reach a conclusion by myself by the end of this video. So, between you and me, I have a watch list full of different dividend compounders, about 50 of them. And when a stock reaches my price target, it lets me know that it's on sale. It basically automates the whole process of trying to dig, research, and find a good stock to buy into when it's undervalued, because once I already do the research, they go on my watch list. Then once the stock market does what it usually does, and it goes on sale, then I usually pull the trigger. And as of right now, Clorox, they're $119, maybe $118 a share, depending on when you watch this. Year to date, they're down by negative 26%. So when we zoom out, they're basically the same exact price that they were back in 2015, almost 10 years ago. So I'm trying to revisit my old investing thesis to see if Clorox is a good buy or not. And in this video, I'm going to be doing things a little differently from the usual format. I'm going to be going over my most important compounder metrics, what makes a stock a very beautiful, good business to invest into, a high quality company. And then also I'm going to be calculating an intrinsic valuation. That way I know whether or not it's on sale. Once we figure out the inherent worth of a company, from that point, we can bake in a margin of safety. That way we can get a good deal. And then towards the end of the video, I'll be giving you my game plan. And by the way, I noticed that on camera and in my personal life, I use way too much filler words. I say right. And so I'm going to be more mindful and diligent on not using the filler words. So if you see my brain check out and I'm silent for like a second or two, I'm saying the word pause in my head instead of saying Because I realize whenever I feel uncomfortable with not knowing what to say next, I just vomit the word or So there's just something about me, and I want you to call me out. If I use the filler words, be like, Amos, you're using filler words, timestamp, 2 minutes and 34 seconds. Why? I would love if you do that. And just in case you're not aware of what the Clorox company is, it's a CPG, and they became very famous during the pandemic for their disinfectant and sanitizing products. And I think that's what most of us associate Clorox with, but there's so much more than that. As a matter of fact, they have 3 different business segments of their portfolio. Their first one is the home and professional care. This is obviously the stereotypical Clorox. It's the sanitizing products, the ones that help you clean your household. They have products that will clear your clogged drains and pipes. They have Pine Sol. By the way, fantastic product to use alongside with your laundry, especially if you do blue collar work, or if you just happen to get down and dirty by doing a little yard work or gardening. Add a little Pine Sol. So beautiful. As a guy that does the laundry almost every single day, I swear by it. Pine Sol is pretty good. So that's segment number 1. But they also have a business arm labeled as Around the Home. And it consists of products such as Fresh Step, it's cat litter, Glad trash bags. This also includes the saran wrap, the cling wrap. When you make too much food, you can't eat it all. You wrap it up, put it back into the fridge if you're anything like me. And then this one kind of sticks out for me. It makes no sense as to why this is in their portfolio. But Clorox is the parent company of Hidden Valley Ranch. Yeah, riddle me that. They also do Kingsford, the charcoal for grilling in the summertime. By the way, that's one of my little ambitions and dreams. I want to own a grill one day. That way, whenever I want to have a piece of steak or some hamburgers, I can just throw it onto the grill. So good. Because as of right now, We buy the frozen burger patties, you put it onto the stovetop. It doesn't taste as good as a grilled burger. And then Clorox also has a third arm of the business known as wellness. And it used to be a lot bigger than it is now, but it consists of Burt's Bees, anything to do with the lip balm, and I think they have a little bit of skincare products as well, but also Brita, the water filter and purifying products. So that's their business in a nutshell. And now let's go ahead and look at some of their numbers and data, the most important part of the video in my opinion. I'm gonna zoom in and make the screen a little bit bigger so it's easier for y'all's eyes. So the first thing that I'm gonna be looking at is the top line. Essentially, for the most part, you do want to see a business that you invest into be growing their revenue year over year. However, in the case of Clorox, that is not happening. Because as we take a look at their revenue, in 2020, they posted $6.7 billion. And then in 2021, they posted their best year ever with $7.3 billion. Because during the pandemic, there was a supply chain shortage of toilet paper because there were some jerks that were running to the grocery stores, to Costco, and taking all of it and hogging all the paper products. So other people had to use newspaper to wipe their bum holes. But during the pandemic, there was a shortage of almost everything, including sanitizing and disinfectant products made by Clorox. As a result, they were able to charge a premium, and that's why it resulted in their best profitable and most lucrative year. Since then, it's kind of just been flat. Trailing 12 months, it's also $7 billion. Now, off of first initial reaction, we might dismiss Clorox saying, oh, this is a stagnant, flat, dying company. However, when it comes to growing the top line, something that we want to be mindful of are divestitures and when you sell a part of your business. Say like you have another product that you sell and then you decide to get rid of it, that's ultimately going to result in your top line decreasing. But that doesn't mean that your company is inherently dying. Does that make sense? And to elaborate further, I did a little more research and I found out that in 2024, they sold their Argentina, Uruguay, and Paraguay business that includes all of their production facilities and the brand rights to everything that they sell to Apex Capital. So Clorox company sold a good chunk of their business in South America away. And also in 2024, they sold their vitamins and supplements arm of the business that used to be a part of the wellness portfolio to Piping Rock. So when you think about it, both of those divestiture is when a company decides to get rid of a part of the business that is no longer profitable or is no longer part of the long-term vision and strategy. And it resulted, by getting rid of that, it resulted in a sale that was less than its book value. Because on paper, they valued both of those businesses to be a lot higher than what they sold it for, which resulted in a reduction of their net income and artificially pumped their PE for a while. Because I think for the longest time in 2024 and 2025, their PE ratio was something like 120, 140. And a lot of people who don't understand how the PE is calculated, they probably dismissed it and was like, dude, Clorox is way too expensive. But their actual PE was closer to a number like 20. And I think as of right now, at the time of making this video, their PE, their forward trading multiple is a 17.4. And we're going to be talking a lot more about their PE ratio here in a little bit. All that to say, when you overestimate the valuation of a business and you sell it for less, you record an accounting loss. But why? Why are they selling parts of their business if the name of the game is to be growing in all metrics? Well, my friends and family, they're trying to streamline their portfolio right now, and through selling those businesses that weren't as profitable, this is going to result in them increasing their margins and them letting go of the slow-growing brands. So I think on paper and how it's playing out, it makes sense. Because the next thing that I want to talk about is their ROIC, the return on invested capital. And the questions the ROIC tries to answer are, how good and efficient is their capital expenditure spending, also known as CapEx? How much profit do they make for every dollar of capital that's invested into the business? And it's usually manifested in the form of production facilities, warehouses, anything to do with helping the business produce more of their products or services. And in the case of Clorox, it's a 23%. Now, friends and family, what you want to be mindful of is an ROIC standard is usually 10%. If you have 10% ROIC, you're doing great as a business. Anything above 15%, and we're usually talking about in the territory of the tech companies like Google, Apple, Microsoft. For Clorox to be posting a 23.6% ROIC, I don't think you guys understand. That is one metric that you can tell from a company whether or not they're going to be a dividend compounder with cheese in the future. A 23% screams that they are efficiently growing their margins and utilizing their capital in a way that's expanding the business in an optimized manner. Because right now it's 23%, and for their 20-year average, it's 18.7%. So by them divesting and getting rid of the companies that weren't as profitable that were a part of the Clorox company, and instead by prioritizing and focusing on the companies that are doing well, we're seeing a shift in their ROIC growing in the right trend. So I think their ROIC, phenomenal. I love what I see. Obviously, with the revenue, you got to read between the lines because off of surface value, they look pretty much flat since 2021. But now that you understand that they're getting rid of the parts of their business with lower margins and the fact that it's still $7 billion, I think speaks volumes as to how high quality of a CPG they are. And the next thing that we're going to be taking a look at and assessing is their bottom line, the profits. After you pay for everything, how much money are they taking home? And the overview number is going to be the net income. So they're posting $694 million right now, increase year over year, 189%. So can you see why selling those businesses were good for Clorox in the end? Because what good is it to operate at a loss or to make like a 0.01% margin like Target and Walmart does when you could just get rid of that and only focus on the ones that are pumping out the numbers and are efficient and good for the bottom line? So their vision and their strategy, I applaud. I think they did the right thing. Once Clorox tried to rebrand themselves as a health wellness company back in 2022, I disagreed really hard with that call because they're trying to copy the playbook of like Church and Dwight and Johnson & Johnson. And I was like, dude, you guys aren't them. You have to focus on your core identity of who makes you, you. And now that I'm seeing that Clorox is doubling down on helping families keep their households clean by making sure that every fridge is stocked with one Hidden Valley ranch, that makes no sense. I think they should get rid of that. Sell it off to Procter & Gamble or General Mills or somebody else who makes food. But between you and me, I would love to see Clorox make an acquisition of one of those vacuum or robo-vacuum product companies. If they acquire that and put that into their portfolio, I think they would have an entire ecosystem of keeping a room or a household clean, and I would approve of it. I'm not a shareholder, but I would like to see that happen. And when we break down their profits per share, then we're seeing an EPS of $5.61. Again, look at the improvement in their net income and in their profitability per share. 2023, we're talking about $1.21. To go from that to $5.61, absolutely phenomenal. In the past 12 months, it's an increase of 188%. So their net income, their revenue, and their ROIC, so far, 3 green flags for me. I guess the revenue can be a little tint and hinge of yellow. Is that the right word, hinge? I mean, a hint of yellow, like a baby vomit, yellow-green. But let's move on to the next one. And that's going to be their dividend profile. As of right now, their dividend yield is 4%. Friends, I don't think you understand. 4% for Clorox is absolutely high. This is a company that I've been monitoring and watching for the past 6 years. Their dividend yield usually fluctuates between like a 1.5 to like a 2.6%. To see it at a 4% tells me that their stock price has been crushed beyond belief, at least in the past 6 years. And when we take a look at the payout ratio, it's pretty alarming, right? 87% of their EPS is utilized, their earnings per share is utilized to fund and finance the dividend. For me, that's bad. However, I think a more accurate way to assess whether or not a dividend is sustainable and healthy is the free cash flow per share. because the free cash flow is the cash that's left over after funding for all of the money that's required for your operations, the overhead costs, funding your employees, the R&D, the marketing. So as we jump over to their financial statement, the cash flow statement, we can take a look at their free cash flow per share. And that's going to be $6.43. So I'm going to pull up a calculator. That way we can figure out whether or not the dividend is sustainable with the free cash flow payout ratio. So $6.43 of free cash flow per share. And then how much of that is going to be utilized for the dividends? So we're going to plug in $4.88 and we're going to divide that by $6.43. And that's going to give us their true payout ratio of 75%. Now that sounds a little bit better than 87%. And that's why it's so important not to just judge and dismiss a company off of surface level values and numbers. Now that I understand that their payout ratio is 75%, it seems a little more sustainable, at least it is in my opinion. If their free cash flow payout ratio spit out a number of like 90%, I would be honest and say that's a red flag. And by the way, if you think I'm trying to butter up this company because I'm a shareholder, I'm not. I'm not invested into them. I'm trying to figure out, should I or should I not? So I think we can sum up, is that a filler word when I say so? I don't know. I guess it depends on who you ask. As I think about it's so hard to talk when I'm trying to be mindful of not using filler words. Try it. If you've never been cognizant on whether or not you use filler words, be mindful of it for just a 1 hour period. And you'll quickly realize it's really hard. Anyways, as I think about and examine their dividend profile, I think it's pretty darn juicy. But what's not juicy is their growth rate. 1.6%. So they effectively are raising their dividend at a very tiny, negligible amount. I don't like to see that. I would at least like to see this number be at the historic rate of inflation or bigger, such as like 3%. Perfect world, I would love to see a number like 7%. To see 1.6%, not too happy. And as we look at their dividend growth depicted visually, it looks pretty darn good. It's basically going from $1.11 every quarter to $1.22. But as we scroll down to look at the growth rate, I mean, since 2022, they've basically been growing the dividend at a rate of like 1.7%, 1.6%. Nothing to write home about. But during the pandemic, when this company was absolutely crushing it, they were raising the dividend by 4.7 to 4.5%. And as I scroll back up here, let me just show you how they dominated during the pandemic. Let's see, past 5 years. So their stock price in 2021 reached an absolute high of $237, and right now they're $119. That is absolutely diabolical. It almost reminds me of PayPal, because also during the pandemic, they reached a bonker valuation of $308 a share, and my, have they fallen from that. They are currently $73. I think if we're going to be talking about what is truly an undervalued growth company that does not pay a dividend, I think PayPal deserves to be a part of that conversation. What is happening with them is just ridiculous, especially for the numbers that they're posting and the growth. Their revenue is going from $21 billion in 2020 to what it is today of $31 billion. Absolutely crazy. You take a look at their bottom line, it's just as beautiful. It's stabilized at about $4.5 billion of profits. When we think about their free cash flow, is it going to get ugly? Is it going to get bad? It's stabilized. That's the second best thing that you can see from a free cash flow stance. Obviously, you want to see it be growing year over year, but sometimes that's just not possible. But to see it stabilize like this, sitting at $5 billion across 5.5 years, I think that's the next best thing, and I think it looks pretty good. If I were PayPal, I think a strategy move that they can do is to implement a dividend, because I think they are doing buybacks. But with how much cash that they are generating and cash that's left over, I think it would behoove them to be a dividend payer, especially because they operate in the finance space. Of course, Nuance, it's a fintech company, but they are still a finance payment processing company like Visa and MasterCard. I think if they gravitate towards being a dividend payer, it might help them. And the last compounder metric that we are going to take into consideration is their debt situation. What you want to know, is it manageable? Are they drowning? Is it too much? Are they highly leveraged to the point where one little push is enough to set them off the edge? That's what we're trying to figure out. And there's many different ways to do it. Obviously, if you're a friend of this channel, I like to do the debt to EBITDA ratio. And to do that, we need to look at their total debt situation. So right now, I'm on their balance sheet. And we're going to scroll down to the point right here, total debt. They have $2.9 billion of debt on hand. And that sounds like a lot. However, when we pin it up against their EBITDA, their operating profits, then we can calculate what their debt to EBITDA ratio is going to be. So their EBITDA is $1.2 billion. So I'm going to tell you right now, off the top of my head, that's going to be a debt to EBITDA ratio of 2. And the golden standard is 3 or less, meaning it would take them 3 years of their EBITDA staying exactly the same and constant to pay off all of the loans that are on the books. And for Clorox Company, their debt to EBITDA is going to be a 2. That is absolutely healthy, and it makes my nipples really perky. I think that's a beautiful number. 2? Dude, are you kidding me? Beautiful. So when I take a look at the compounder metrics, I really like what I see with this company so far. Now for the next part of the video, I'm going to be calculating an intrinsic valuation of how much Clorox should be valued at per share based on the numbers that they're generating. The first one is going to be predicated upon their free cash flow. So for the past 6 years, on average, their free cash flow has been growing at a rate of 10.8%. But plug it in 6.5% for the foreseeable future, then their DCF price is going to be $117 a share, which is essentially what they're trading for right now. I think their 52-week low has been $117.35. So right around that number, if it's only based on the free cash flow. But to cross our T's and to dot our I's, we do want to do one more intrinsic valuation calculation. And that's going to be based on their dividend. So using the dividend discount model, for the past 5 years, their dividend growth rate is 2.4%. Because as we learned earlier, during the pandemic, they were growing it at like 4.5%. But for the past like 2.5 to 3 years, it's grown at a rate of like 1.6 to 1.7%. So I guess we'll meet in the middle. We'll say 2.4%. Plugging in a weighted average cost of capital 5.9% into the formula, then Clorox should be valued at $142. And if we compare our valuation numbers to what the Wall Street analysts believe, this is where I fundamentally disagree. I don't agree with them. They think that Clorox should be about $149 a share. After looking at their numbers and how it's growing, it's not growing at a rate that reaches and derives a number of 150. I just can't agree with that. It's just their median price target is 150. The average is 149. I think that's just way too high. The guy who's saying 129, I think that's more of an accurate depiction of what Clorox should be valued at, especially with the tariff situation. One thing that you have to know is that the leadership disclosed that they're going to have to face a $100 million setback for the next 12 months due to the ramifications and consequences of the tariff situation. So when I think about their cost to do business right now being higher and their growth story kind of being slow, this number right here, way too high. And this guy, dude, he's smoking something. I don't know what he's thinking. 170, not for Clorox in 2025 or 2026. Now, in the future, things could change, obviously. The tariff situation could disappear. Maybe cleaning becomes more of a readily accepted behavior and chore to do in our households. So consequently, Clorox products go flying off the shelves. Then we could talk about 160, 165. But 150, I just can't agree with what the Wall Street analysts are thinking and seeing. Because after crunching my own numbers, I can't. So based on our math, we're saying that Clorox, I don't know why I keep saying Costco. I'm editing it out so you guys don't hear it, but I refer to Clorox as Costco like 10 times already. I think it's just Costco is just in the back of my mind, that Freudian slip. But anyways, we're saying 130. And if we bake in our price with what the Wall Street analysts believe, then we reach an intrinsic valuation of about 140 a share, which to me sounds a little bit more fair than 150. And remember, as a reminder, they're currently trading for about 119, 118 a share. So what's a good or a fair price to buy into Clorox? So based on the numbers that we are seeing here today, I think a good price to buy into Clorox would be anything below 117. And I think a really good price will be below $110.50 a share. Will it ever reach those valuation and prices? Probably not. Maybe. However, for the past 200 days, their 200-day moving average, they are in a downward trend. They're trading lower and lower by the week. So, by the end of 2025, I think they have a higher probability and a chance of them reaching $110 a share than they do of reaching $150, if that makes sense. If I were to bet and gamble, which I don't like to bet and gamble, my risk tolerance is really low, I would say that they would reach 110 before they reach 150. Who knows? So to wrap up the video, what is my game plan after taking a look at and revisiting my investing thesis surrounding Clorox? Well, I think Clorox is a part of the CPG sell-off that's happening right now. You think about all of the household, big blue chip dividend compounders like Procter & Gamble, Kraft Heinz, General Mills, anybody and everybody a part of the CPG group is going on a huge sell-off in 2025. And what you have to understand in the stock market is that sectors go through this. In any given moment, some industries and sectors, they're in favor and some are out of favor. Rarely will you see everybody succeeding and thriving and flourishing at the same time. Like in 2024, I think the REITs were just getting absolutely hammered. But the high quality ones, a part of any sector or industry, will eventually rebound once enough time passes. Case in point, 2024 was the REITs. 2020 was the oil and gas sector. My gosh. I remember the narrative and rhetoric back then was that the EV, solar, renewable energy was just going to eat up and make the oil sector obsolete and make them vanish. Did that happen? No, but they all went on a massive sell-off. Chevron, ExxonMobil, BP, all of the big oil players, their valuations dropped by 30, 40, 60%. And now if you take a look at them today, they're some of the best performing stocks. In 2022, a sector that suffered harshly was the big tech sector. Meta, Google, Amazon. Dude, 2022 was a rough year for them. And 2025, I think, is the CPG's turn. The value stocks that have good balance sheets and are posting good numbers are getting hammered, slashed, and crushed. And to that, I say this. I think Clorox is one of the few hundred stocks out there that are a buy and hold forevers. Because when you think about all of the businesses that operate in the stock market, not all of them can be high quality. Not all of them can be good businesses. But when you think about which ones are buy and hold for the next 20, 30, 40 years, that number gets even smaller. And I think Clorox is a part of that category. I think it's an easy buy for me because when I think about Clorox, they usually trade at a very high premium. Case in point, turn your eyes to your screen. For the past 20 years, their PE, their trading multiple, is usually a 53 at any given time in the past 20 years. Right now, friends and family, it's a 21 for the present tense, but their forward trading multiple is a 17. That is really freaking low. That means their stock price has been getting crushed beyond belief to the point where it doesn't even make sense in terms of valuations. Because when you look at the historical averages, talk about 15 years, 58. Talk about the past 10 years, a 64. Past 5 years, 71. For them to be a 21, kind of ridiculous. We're not going to look at this number because it includes their divestitures and then their PE became really high because of that. So we're not going to look at the past 12 months, but looking at it today at 21 just makes no sense to my small, smooth pea brain. And as we click out of this Japanese ad, I live in Japan and that's why I get these weird ads. And as we take a look at their dividend yield for the past 20 years, it's usually around 2.9%, sometimes 3%. Right now, it's a 4%. That means their stock price has been getting so crushed to the point where their dividend yield is getting artificially inflated. And we learned from their free cash flow situation, it's sustainable and healthy. So I'm going to be buying into Clorox. Please don't follow me into this, but as a value investor that likes dividends, I think it's an easy buy for me. I'm going to be buying in at around like 117, 115, 110 a share. Sign me up. But before I sign out of here, I want to hear from you. What do you think? What am I missing? How do you feel about Clorox? What's the bull case, bear case? Do you like them? Do you not like them? Let me know. Because after looking at the numbers and revisiting my investing thesis for this company, I like what I see. And I just don't want to be operating in this tiny little smooth pea brain echo chamber of like, it's a good company. I want someone to poke holes in my thesis. So if you could do me that favor, I would appreciate it. Anyways, I love you guys. Stay safe. Good luck in the stock market. And I will talk to you next time. Have a good day.